I'm Siegel with Elazar Advisors. Today we're going to recap what we said last week on the S&P 500, on gold, on bonds, and the dollar. And we're going to show you what the next move could potentially be. We're going to run through our calls. We're going to show you some of the new drivers and catalysts and the technicals where we could go. Here's our website, Elazar LLC. This is a call, I believe, from last Monday. And we said that the S&P 500 was holding a nice line since the elections. And we also pointed out that around June 2nd, the market peaked out because we think, due in part to a bad jobs number. The jobs number was much below expectations. Friday, we had a great jobs number. It was well above expectations. And that's because the S&P 500 to hopefully bottom and catch this uptrend. Here's the latest chart. This is as of Friday. You can see that even the lows, they threatened to even touch the line, and they moved up and away. So it looks like that this line, we have a definitely channel here, and the middle line, the market seems to be moving on that at the minimum. And we think we have good enough news that the market should hold this line. What's the news? We think there's two main factors that drive stocks. Jobs is the most important economic indicator, but earnings is as important as you get for stocks, because when stocks are valued based on what people expect for the earnings and going forward. So we have earnings season starting in about 2 weeks or in a week or two, and Q1 was great earnings. It was the best earnings growth we had in almost 6 years. Q2 is probably setting up to be another good earnings period. So you have a combination of technical support. You also have a great jobs number, and you're going into a good earnings season. So we expect that we should start to hold and start moving back up. We also had a good, strong short-term signal to buy, which is the first time we've had that special signal. It's a proprietary quantitative signal that we have, and we haven't seen it go by in about 2 weeks. Let's go back to our last week's call so we can review. Okay, here we are. And we also talked about gold. Let's look. Oh, I just want to recap. With the S&P 500, we did say that May 22nd, that there was an important low here. This was the low, and we thought that it would hold that price for the rest of the year. That's incredibly important, and it's also a huge call to say that we're not going to go below that level. We'll see how it pans out, but we have some conviction there. Here's gold. We said last week, turning bearish, and here's the chart at that point, pre-market. Turns out that the gold did drop that day. Let's go to the most recent chart. S&P and gold. Here we are. Gold, you can see that this was pretty much the chart that we showed last week when we made the call. And after that, it made a sharp drop straight through. On a shorter term basis, we're even more bearish. We think the combination of weak inflation numbers in combination with a very hawkish Fed, meaning the U.S. Federal Reserve, they want to raise rates, they want to exit their bond portfolio. This is all with an effort to stamp out inflation. That's what these moves usually do. And so you have gold that depends on inflation. It's a commodity. So the more inflation you have, the better gold it does. So if you have low inflation already and the Fed making moves to stamp out inflation further, it's obviously pretty bad for gold. We have a key level here, 114. You see that it had amazing support and resistance. It was an incredible point. Failed here, broke out here, failed here. You see a lot of action right around 114. This is the GLD ETF. We think it's better to buy to trade the actual commodity, but we like using GLD when we're talking technicals and doing the quant model. Also, you see here that it exactly held this 114 level. We think if it breaks the 114 level on a closing basis, it's very bearish, and we need to be careful. Let's go back to last week's call just so we can recap. Okay, we're going to go to bonds. Bonds, we said we were bearish. and bonds was already making a move after going up. We typically don't like to be bearish in an uptrend, but we were able to catch. We were short above it. We were a little worried when it broke above it, but we had confirmation when it came back in, and we were bearish. Let's go to the most recent chart of bonds. Here we go. You'll see that it dropped further. We were bearish. Now we're turning bullish. So you see here that we drew a line at 122.50 roughly. This is the TLT. This is the ETF. And you see that it had key action of support and resistance at this key level, 122. And you see that this level held bonds from going higher. And it also acted as a breakout. That's where we drew all these arrows. We happen to be at that line. We think this line, it could trade below or above in the near term, but we think that at some point in the near term, bonds should show a decisive holding above this key support resistance. And if it does, you have confirmation that bonds could hold this uptrend that you see the uptrend forming there. Some of the drivers would be baby boomers. They don't want to let go of their bonds. The baby boomers are the biggest percentage of the population. And because they're older, they want safe assets. So even though that the Fed is saying that they want to get out of their bonds, you have major holders that they're not going to get rid of their bonds. Also, the Fed didn't get out of any bonds. If anything, they're just buying less, but they're still in the open market buying. So even though you have a big drop, you can have that, you get some support, especially since we see an uptrend. Plus, most people aren't as bullish as us. We're pretty bullish about the back half. People are not bullish, so that means that investors can shift to bonds even still, as most people are still worried. Let's go back. Okay, we're going back to last week's call. Lastly, with the dollar, we said it was in a downtrend, and we were fundamentally bullish, but I think we said last week that we don't want to catch falling knives. As long as it's going down, you're in a downtrend, it's tough to have a bullish call, even though we think fundamentals are turning more bullish because you have inflation turning up. We think the political environment in the U.S. is bottoming. We think Trump is going to get more support than he's had in the past. He's going to have some wins, and we don't think it could get worse politically. Let's go to the most recent chart for the dollar. Here we go. You can see that it hit the bottom of this downtrend. That's not bullish, right? You don't want to bet against this. If anything, the real trader technical call would be you wait for a bounce and you short it. But we have a proprietary model, quantitative model, and it points out that we have a new refresh of a support resistance level at 24.90. You could see that this level was important. It held the market here. It acted as a breakout here, and the dollar never turned back. So we did break down from this level. We're going to use this level as a buying catalyst, meaning if we close above 24.90, this is the UUP, this is the ETF. Again, we like using ETFs for our quantitative models. If we close above this level, then we think it's going to be very bullish. And we're going to use that level, that if it closes below that level, that's our stop. It's a pretty tight stop, but we think our level is pretty important. So that's what we're doing. Tomorrow, we hope to talk about gold, and we'll go more into detail on gold. We thank you for joining us. This is Chaim Siegel with Elazar Advisors, and we're here for you, and that you learn, profit, and repeat. Thank you for joining us.